this module, I wanted to introduce you guys to the concept of capital adequacy. There's a lot of different phrases for this. Some people call it solvency. Some people call it liquidity. But particularly in light of Dodd-Frank and sort of the language that's used in that for businesses now, capital adequacy is sort of the new term. And quite frankly, it simply has to do with having enough capital. So, what do we mean by that? Well, capital can be, on the one hand, some sort of cash. It's either cash or things that you can turn into cash. And so that could be marketable securities. It could be some asset you can sell, those sorts of things. That's one definition of it. And that's much more of a cash type definition or cash related definition. The other, from a corporate standpoint, is simply the assets of a firm. Technically, all of the assets of the firm can be turned into cash. It's just a question of when. That's what makes them assets. And so capital can be thought of as assets. Adequacy is that there is sufficient capital to meet the firm's needs and satisfy their objectives. And so from a cash perspective, that means one thing. From an asset perspective, that means something slightly differently. So let's talk about that. First thing we'll talk about is what I refer to as the balance sheet perspective. And this is sort of a longer term kind of strategic view of capital adequacy, and that is that the value of the firm's assets should exceed the value of the firm's liabilities. Very simply, if you stopped and you thought about that, that means that you have positive owner equity. Now, you can think about this. We'll talk about that in a little bit more in detail here in a second. But you can think about this as just simply being the definition from a legal standpoint of financial solvency. So if you have creditors that maybe you've sold debt to, they have certain standards for evaluating whether the firm is solvent. And quite frankly, that does not necessarily have to do with whether or not the firm is still operating or even making its bill payments. It's generally defined as that the value of the assets exceeds the value of the liabilities. Therefore, the debt holders could reasonably get fully paid in the event that the firm shut its doors and had to liquidate. And so, from a legal standpoint, if a company is no longer financially solvent, the debt holders have the right to go to court and seize control of the company, even if the company is still making all of its debt payments. The second perspective is what I would call the cash flow statement perspective. So again, balance sheet's one financial statement, cash flow statement's a different one, different kind of more specific look. And it very simply says that at any point in time, the balance in the cash account should be positive and sufficient to support daily operations. Daily operations would be just the normal paying bills that's required, handling accounts receivable and payables, interest payments, all of those sorts of things. And obviously the implication there is that if at some point you don't have sufficient cash in your accounts to support your daily operational needs, then that must mean that you're not paying your bills on time, and so you're defaulting or delaying payment on those. And that also, depending on the situation, gives your creditors rights. And if the creditors are debtors and you've not paid them their interest payments, for example, or their principal payments, they can go to court and either demand payment or demand that they take control of the company away from equity holders. So capital adequacy is all about, at the highest level, is all about ensuring that there is adequate capital there to make the payments and the obligations that the company has signed on for. I know this is the last thing that we've talked about, but it's actually the single most important thing for a firm. I know a lot of people think the most important thing for a firm is that it be profitable. Being profitable is a luxury. In any one period, the company could run a loss and still be okay. running out of capital is not a luxury. When you simply do not have enough capital to meet your liabilities or to meet your obligations, you get shut down. That's bankruptcy basically. The primary job of managers is to do what's best for the stockholders, right? Create value for the stockholders. If the company does not have capital adequacy, then the stockholders lose the entire company to the bondholders. And so it's not just my stock value went down, they're actually no longer the owners of the company. And so it's the single most financially devastating thing that can happen to the stockholders, and they will not be happy with you. And so in reality, in order of sort of importance as a financial manager of a firm, the number one most important thing for you to do is to have capital adequacy. The second most important thing for you to do is to generate profits. And then the third most important thing for you to do is to maximize those profits to the benefit of the shareholders. So first you have to have capital. Second, you have to have profits. Third, you have to do as good as you can in terms of generating profits and building capital. So quite frankly, this is the bedrock of financial management. The thing that you absolutely have to be sure about every day. So let's talk a little bit more about the balance sheet perspective. I'm going to flip over real quick to our CapSim simulation that you guys are going to get involved in and show you an example of a balance sheet. Again, they can come in different forms. You should have seen all of this from accounting and so forth. But in the balance sheet perspective, quite literally, all we're looking at is we're looking at a total asset number, then we're looking at a total liability number, and the difference between those, on some balance sheets it will be broken out as owner's equity or total equity, but this should be a positive number. So the 130 minus the 72, with rounding, that's like 58 million. So they have adequate capital from a balance sheet perspective. They have $58 million in capital. Further, if you look at it just from a common sizing, they have a 44% adequacy, meaning that their equity is 44% of their assets. They have that much more equity above and beyond their liabilities. Said differently, of their assets, 55.7% are liabilities, 44.3% are equity. So that's a pretty good thing. Obviously, I know it's hard for you to imagine, but it is absolutely possible for a variety of reasons for this to become upside down in a company, and it now has, let's say, assets of only 70 million and liabilities of 130 million. And so you could actually see this being the reverse and them being that far underwater. Now, generally speaking, that won't be something that lasts for long. So if that happens, if there's some event that causes this to flip, generally speaking, as soon as that is known, the debt holders will go nuts. So all of these liability owners, in terms of the long-term debt holders in particular, will go nuts, go to court, and do whatever it is that they have to do to take control of the company so that they can make sure that they get paid. So at the end of the day, it's not likely that you're going to see a huge imbalance here unless it's just one big surprise. It's not likely that you're going to see this balance persist over time from a balance sheet perspective, because the creditors will not let that happen. Let's see. So, sorry about that. Got to get back to our presentation here. There we go. So, let's just kind of put some numbers to that so that you can think about it. If we thought about this from a market value perspective, I think we did it. Yeah. Okay. So from a market value perspective, so not looking necessarily at the financials, but looking out in the market, we look at the value of the entire firm as being the enterprise value. And that's the market value of the equity plus the market value of the debt. And so from a market value perspective, we need the enterprise value to be greater than the payoff on the debt. All right, so let's just say that you have a company that's got an enterprise value of $1 million, the debt payoff, and so what it would take for them to basically buy back all of the debt today and at current market rates and have no more debt, let's just say is 300,000. Then if they were to do that, if they were to liquidate the firm, they would raise the $1 million in value from selling the value of the company, use 300,000 of it to retire the debt, and have 700,000 left to go to equity. And so that would be sort of a way of thinking about this. So the other way of thinking about it is very simply that it means that the stock value is positive. If we think about enterprise value as being the value of the stock plus the value of the debt, then obviously enterprise value minus the value of the debt is equal to the value of the stock. And since the definition of adequacy is that the enterprise value be greater than the value of the debt, that means the value of the stock must be positive. In our example, it's $700,000 worth is the value of the stock, the market value of it. So that's another thing that really signals to you that a company is potentially on the brink in terms of capital adequacy, is their stock price plummets. And so you do start talking about what are called penny stocks, where the per share price on the stock is less than $1. So you can buy it for pennies instead of dollars, is why they call it that. And so that's that's also another indication. The hard part about really just using the stock price itself to understand this value is there are some companies that intentionally target very low stock prices anyway. They issue lots and lots of shares, and so each share is just not worth much. But that the total value of all those shares is still worth a lot, right? And so I don't want you to focus too much on stock price. I want you to focus on the market value of stock, so the market capitalization value. When you look at that, obviously, if that starts to be quite low, that's what really becomes a problem. The other perspective, very simply, would be the book value perspective that we already looked at. And so, again, you would just read the asset amount, you would read the liability amount, and whatever the difference is, that's how much the owner's equity is. And so, again, we already gave that example. So the thinking about that balance sheet perspective for just a little bit, let's think about the kinds of decisions a firm might take that could put it into some sort of capital adequacy situation. When the firm buys assets, they should think about buying assets that will generate adequate cash flows to at least pay back any debt that they use to finance the asset. And so we generally handle that in most cases, when we do like net present value analysis and so forth, and we're looking for an expectation that if we make these investments, that the payback from the investments will be more than enough to pay off the financing costs and so forth. Sometimes things won't go the way we think they are, or an asset will simply no longer be useful to us because of the way we're operating our business or the condition of the asset. And at that point, a firm can help its capital adequacy by selling that asset off so that they can retire the associated liabilities, or at least some of them. And so by doing so, they would be reducing the liability and therefore, less issue with how much needs to be paid back. In terms of liabilities, kind of decisions you can take related to liabilities, we like to use debt to finance our assets because it increases the return on equity for the assets or for the investment. And if you think about that, if I basically go out and raise money, let's say from debt, say I raise $100 million in debt, and I use it to turn around and buy $100 million worth of asset, then my asset and my liability both went up by $100 million. My capital situation, so my capital adequacy hasn't really changed. All right. At the same time, though, by financing this with debt, not using as much equity, to the extent that that asset generates returns, profits, that are in excess of what it takes to pay the interest on the debt, then all of that now goes back to equity holders who didn't put a dollar into, didn't put a single dollar into buying this asset. And so for them, that's a fantastic return. And so there's a real incentive to want to do that, provided that the assets are productive and productive enough to cover the cost of the financing. However, sometimes firms borrow money and they spend it in ways that don't involve adding assets. And so a couple of different examples of that. One is they might just borrow the money to have it in their cash account. Maybe they feel like they just need to have more cash for their operations. It's not earning any kind of interest or anything, but over the course of time they're having to pay interest. Over time it's eroding the capital adequacy. Similarly, another example might be that you borrow the money and you use that money. It's a capital expenditure, maybe to upgrade or repair something or whatever else, but it doesn't necessarily add to the value of an asset. It doesn't create something that you can turn around and sell and recapture that money. And so one of the examples in one of our projects was somebody wanted to borrow money to basically do the build out on a new space for a business. Well, it is a capital expenditure, but if the business goes under, they can't turn around, the lender can't turn around and sell the build out to help recover part of the money that they lent. And so in that sense, it did not really add to the asset per se, and therefore it reduced capital adequacy. And then the last example on that is that if you borrow money and the whole reason that you're borrowing the money is so that you can pay a dividend or repurchase stock, basically make a distribution to equity, then you're increasing a liability, right, without generating any asset. Instead, what you're doing is increasing the liability so that you can pay down and, in some sense, decrease the value of the equity by making a distribution out, the equity in the company, by just giving the money to the equity holders, and that will always reduce capital adequacy. So if you do that distribution, whether you do it through borrowing or not, it's always going to reduce adequacy. If you borrow to make the distribution, it's like doubling down, and you've really reduced the adequacy. And so that's not a decision that a company takes lightly, to borrow to redistribute. You would only do that if you felt like, from a capital standpoint, you were in great shape. So let's talk about the insolvency scenarios just a little bit. Well, actually, before we do that, I want to talk to you guys. Let's do this. All right, we'll talk about the scenarios, and then I'll give you an example of how you might look at this. So first scenario might be a company that just makes a bad investment. So for example, say they spend $100 million on a new product idea. It has an expected net present value of $100 million. So remember, net present value would mean that it's going to earn $100 million more than the $100 million that they spent on it over 10 years. And let's just say that they're going to fund it all with equity. So we're not even bringing debt into this at all. But at the end of the third year, the product has a cumulative earnings before interest and taxes of minus $400 million. So it's in the hole. Instead of getting plus $200 million over 10 years, it's already minus $400 million, and maybe doesn't look like it's going to turn around. So the company decides to liquidate it. They sell off the equipment, do whatever else, and so they're now you're now looking at a $40 million price tag on what they get for what they sell off. So they spent $100 million to buy it. They lost $400 million running it, and now they've only gotten $40 million back when they sell it. And so the impact on capital adequacy is they spend the $100 million cash to buy the product, buy into the new product. But at that time, they book $100 million in assets for buying it, and so their capital adequacy looks great. Over the course of the 3 years, they have a $300 million reduction in retained earnings, so that reduces their owner's equity by that amount. Then they turn around and sell the asset for $100 million or for $40 million, and so take a $60 million loss. That further reduces the owner's equity because now they've taken $100 million off of the asset side for long-term assets and replaced it with $40 million in cash. So it's a $60 million less. So the total is that they are a $460 million reduction in owner's equity and also a $460 million reduction in capital adequacy. Okay, so hopefully they had enough to cover that, but this would be an example of how somebody maybe doesn't have $460 million in their capital, their owner's equity account. And so, quite frankly, this puts them in bankruptcy or insolvency, I should say. Second might be a bad use of debt. We talked about this example. Let's say they issue $100 million in debt to hold in cash. That's all they're going to do with it. They're going to pay 10% interest per year on it for 10 years. So at the end of the term, 10 years, they've paid $100 million in interest, and then they also have to pay back the $100 million they borrowed. And so the cash account is ultimately going to be reduced by $20 million at the end, but the liabilities are only going to be reduced by $100 million. Cash reduced by $200 million over the life of it, and liabilities, when it's paid off, will only be reduced by $100 million. And so they're worse off. And so if you think about it sort of step by step, they increase cash by $100 million, but also increase liabilities by $100 million when they borrow. There's no change in owner's equity. Over the 10 years, they pay out $100 million in interest. They don't have any return to show for that because they just put it in the cash account, so it didn't go into an asset or whatever else. And so on a net basis, they've lost $100 million in capital adequacy or owner's equity there. And then at the end, they're going to pay off the debt. So that's going to reduce the liability by $100 million. But it's also going to reduce the cash by $100 million. And so the asset goes down, the liability goes down, so no change there. So it's really just the interest that was paid without getting any return on that investment through operations or whatever else that's cost them. And so they're $100 million worse in terms of adequacy at the end than they were at the beginning. Again, if you're a company that can afford to do that, then so be it. But that raises the question: if I'm a company that can afford to absorb $100 million drawdown in owner's equity without batting an eye, then why am I a company that needs to borrow $100 million just to put in a cash account? What's going on there? So usually you see this kind of behavior with companies that are very cash strapped. They don't have $100 million to spare. And yet they've got a lot of volatility or uncertainty going on in terms of their cash flow needs. And they're doing this because if they don't do this, then they will begin to miss payments. And so in some cases, it's like delaying the inevitable. Over the course of the 10 years, they now have enough cash to make their payments. But by the end of the 10 years, their balance sheet capital adequacy goes away, and that's how they wind up being owned by debt holders. The third scenario, again, very simply, imagine that the firm just decides, whether they do that by borrowing. You could do it by borrowing, that would be worse. But here we're just saying, let's say the firm just decides to make $40 million in dividend payments to equity investors. So they reduce cash by $40 million. There's no other offset or income or anything else to cover that. And so that immediately reduces owner equity by $40 million and capital adequacy by $40 million. So the decision to pay a dividend, if you're paying it and it's because you have a whole bunch of cash on hand and you see no reason to hang on to that cash, that's fine. But the decision to pay it is, no matter what, is a reduction in capital adequacy. So you really only want to do it when you have so much capital adequacy that maybe your investors see that as a problem, that you've got a lot of idle cash sitting on your balance sheet doing nothing, and they would rather have that back. Otherwise, you can put yourself in a bad situation with your bondholders. Now, I'm going to flip back over to CapSim. I want to show you guys this real quick. When we're in CapSim, log me out. Sorry, let me log back in here. When you're in CapSim, give me just a minute here. I'm going to log into a team. You do have the ability to look at what the CapSim, what CapSim is projecting for you. So they create a forward-looking balance sheet for you based on the decisions that you're making in a particular period. And so you can look at the pro forma balance sheets. And so, for example, for this particular person or team, based on the decisions that they are intending to make over the next year, it does tell them what their total assets are, or what they're projected to be at the end of the next year. It tells them what their total liabilities are projected to be at the end of the next year. And so tells them that they should have a $53 million equity, which is also capital adequacy, at the end of the year from a balance sheet perspective. And so companies actually do this. This is not just in the simulation, but they put together pro formas partly so that they can assess whether or not their adequacy is going up or going down. I showed you for this particular team what their adequacy was the prior year, prior to this pro forma, and they had a 44% adequacy in terms of their total equity. It's now down to 42.4%. So you can see that they are going backwards a little bit in terms of their adequacy. It's slipping. It's at such a high level that I don't know that anybody would care, but you would want to pay attention to that trend in terms of where the adequacy is, both on a dollar basis and on a percentage basis over time. Just to make sure that as you're projecting out, that you're not planning to become inadequate. Now flipping back over, now we're going to jump to the next perspective, if you will, and that is the cash flow statement perspective. Remember, the cash flow statement perspective simply says that you have sufficient cash flows. And so in a cash flow statement, you can think about cash flow statements as basically taking a starting balance in your cash account, thinking about the sources of cash that you're going to be able to draw from over a period, the uses of cash, and then based on that telling you about sorry, I'm going to add a zero there. But based on that, telling you what your ending balance is. And there's both a backward-looking and a forward-looking version of this. So again, if we go over to CapSim real quick, you can basically look and see on the same annual report where you have the balance sheet, there's a cash flow statement. Now, CapSim does it a little bit differently. It does its cash flows statement by activity, all right? And so the key things for you to understand, first thing that you're looking for there, it has a closing cash position. This is closing cash for 2018 versus 2017. So the closing cash in 2017 was $3.4 million, basically. Okay, so that's really what you're starting with. And then you're going down here and you're saying, oh, in terms of what happened from operations, I ran a loss on income, but part of that was depreciation expense, which is non-cash, so I'm adding that back. The accounts payable, I was able to pay, maybe increase my accounts payable, so I'm basically borrowing from lenders or from suppliers, and so that went up. Inventory went down, I guess, so we got cash from inventory. Accounts receivable went up, so we lent more. And so net from operations, when you take all that into consideration, I'm going to get $12 million from operations this time. My plan, and this was last period, this is not necessarily what I'm planning for next time, but my last period, I spent $31 million on plant improvements. And to help fund that, I went out and raised $32.6 million from sale of common stock and sale of long-term debt. And so basically the net change that I have is 12 minus 31.2 plus 32.6. So a change of about 13,646,000. So if I take this number, the 13.646, add it to the 3434 that I started with. So I started with this, I had this change, I end with this, the 17,079. So that's how you would look at that cash flow statement. Again, it's a little bit different structure. Different companies do it different ways. But the beauty of this is that you can actually go in, kind of see what accounts matter, right? What decisions matter in terms of cash flows, and basically see where it's being used. Used would be negatives, and where it's coming in, right? So sources would be positives, and get a real good idea of what's causing your cash flows, your cash balances to change. All right, so usually the way that we put ourselves in a bad capital adequacy situation on the cash account is that we fail to properly anticipate either how big a source of cash will be, maybe we overestimate or overexpect a source, or we fail to properly and we underestimate a use. Now, the confusing part about that is income. Income, if it's positive, is a source. If it's negative, it's a use of cash. And so the fact that your income from year to year, your net income fluctuates and sometimes can be positive and sometimes be negative, that's a really big factor in this. But generally speaking, there are a handful of accounts in general that represent the sources and uses of cash. I have broken them out into a scheme that I like to use: discretionary, semi-discretionary, and non-discretionary. Discretionary means the cash either moves in or moves out because of a decision that you make. It is completely to your discretion whether this happens or not. Semi-discretionary means that you have some policy or some control over what happens with the source or use, but it is also driven by sort of your overall firm performance and so forth as well. So you have some control, but not perfect control over this. And then non-discretionary are things that you don't get to decide; they happen to you, and those sources and uses are the ones that you really have to account for. From the standpoint that they're 100% not in your control. So the discretionary sources and uses of cash, obvious ones, I can decide to either make investments or sell off assets, right? So I can either buy assets or sell assets at any point in time, completely my choice. If I'm buying assets, that's a use of cash. If I'm selling assets, that's a source of cash. In terms of financing, I can either issue or early retire debt, or I can retire equity. There's no early retired equity, but no retirement of equity, but you can early retire it, right? And so this is under your control in these cases because, so let's look first of all at the issuance. It's always under your control as a source of cash to go out and raise money. Now, it's not necessarily under your control how much you will raise. Again, you'll do a stock issue and have a decent idea of what you think the stock will sell at, but it's not 100% under your control. Same thing with debt. You may do a debt issue, but it's not 100% under your control what people will actually pay you for the debt. But it is under your control that you decide to issue it. In terms of retiring debt or equity, it is 100% under your control to decide to early retire debt. You early retire debt by going out into the market and purchasing the debt back from the people that currently own it at whatever the market price is. Same thing with equity. You would go repurchase the equity from shareholders. And that's completely a decision that you can make. It's a use of cash. It absolutely, as we talked about, even from a balance sheet standpoint, affects capital adequacy, but it's 100% in your discretion. Same thing with paying a dividend to equity holders, 100% in your discretion. It is a use of cash, 100% in your discretion. Semi-discretionary sources and use of cash, accounts receivable, accounts payable, inventory, or work in process if you've got that. Firms can set like an accounts receivable policy, giving people the right, giving their customers the right to delay payment for some number of days. And they can go in and change those terms for any new sales, but they can't retroactively go back to somebody that they've granted, say, a 90-day credit terms and on something that they bought, and then arbitrarily say, we've changed it, it's 30 days, you need to pay us up now. They can only do it on new transactions. And this is semi-discretionary because while they can control the offer of credit terms, they can't control, number one, the actual use of it. So in some companies, 100% of customers use the accounts receivable terms. In other companies, something far less than that use those. And at any point in time, that could shift. And so let's say that the economy gets bad, and because the economy's bad, you go from having 25% of your customers buy on credit terms, receivable terms, to having 100% of them buy on that. Well, the amount of money you have effectively lent to customers has just increased 4 times, and that's a use of cash that was not in your control. Okay, you may respond after the fact by saying, "Oh, we're going to have to reduce our credit policy back to, say from 90 days to 30 days or something like that," but that's only gradually going to free up this big amount of cash that's tied up in there. And so from a cash flow statement standpoint, that can suck a bunch of cash from you. I like picking on that one because it's sort of non-intuitive. You can as a company do well. You can have sales grow, and because sales grow, but a significant portion of your sales are purchased using your credit terms, your receivable grow, and so it is actually possible in some companies to see your sales grow and your cash fall. And so the company is doing too well, and because it's doing too well and its customers are taking advantage of its credit terms, it's actually running out of cash. And basically what's happening there is, think of it as you as the company have spent all of this money creating the product, buying the product, whatever it is that you do to put a product out there for your customers to buy from you. You've spent all of that money. You've actually sold the product, but you haven't got paid for the product yet. Okay? And so you're in the process of now having to come up with more money to buy more product for the next round of customers that comes in, and you still haven't got the money from the first round yet. And so that all of that is what we call working capital, and that can be oftentimes one of those things that really sets you back. Now, accounts payable is a little bit different here because you can either decide to or decide not to take advantage of credit terms from your suppliers. So it's a little bit more in your control. Inventory is one that we really have to focus on. We make inventory with the idea that we're going to sell it, and if we don't properly match the amount of inventory we make with the amount of sales that we're going to have, we could wind up with a bunch of inventory sitting on the shelves. Again, you have to have a certain amount of inventory in most businesses, so that's not terrible. But if you have too much inventory, very much like accounts receivable, although for the complete opposite reason, right? With accounts receivable, your problem is you were too successful at selling things. The inventory situation is, what if I spent all the money to get all of the inventory, put it on the shelves, and then nobody comes to buy it? Well, I've already spent it and I already have to make the payments to the vendors, but I don't have any cash coming in. And so inventory is a consumer of cash as well. All right. Then you have your non-discretionary sources and uses of cash. Obviously, operating gains and losses. We've already kind of talked about that. If you have a gain, that's a source. If you have a loss, that's a use. Principal payments on debt, that's non-discretionary. So you may have to retire your debt or at least make some principal payments on your debt in accordance with whatever the terms of the debt are. You have to do that. If you don't, you're in default. And if you're in default, the equity holders lose the company. The debt holders own the company. Not a good thing. And so that is a use of cash. And because that only comes on every so often, sometimes companies fail to account for that in their cash budgets, and that can put them in a tight cash situation. And the last thing I'll just kind of throw in there, legal judgments. You may have a legal judgment in your favor. Maybe you sued somebody, and you're still, you're hoping that you get money out of them, and then the judge awards and you actually get the money. So that's a source. Or somebody could sue your company and get a judgment against you, and assuming that they do and you make payment, then that becomes a use, and that can sometimes be the one really big surprise that swings your cash abilities, capacity from being positive to being negative, and very non-discretionary, I would say. So want to show you again in CapSim just real quick that you do have, in addition to the cash flow stuff that we talked about before, or the balance sheet pro formas, there's a cash flow pro forma. And it, again, looks just like the cash flow report that you saw, except for that this is a projection for the next period for this team. Right now it's projecting that they would run a loss. So they would have again, this is the non-discretionary result, right? They would have this $4 million loss. The depreciation on it that just comes from that offsets that, because remember that your income or loss has depreciation in it, and that's non-cash. So when you add it back, you actually wind up okay. Your accounts payable, you're actually getting some cash back from that, which probably means that you're borrowing a little bit more from your suppliers. Change in inventory, you're losing $1.6 million in inventory. And so again, that's what's projected. It represents that you're going to spend $1.6 million more on inventory this year than what you get, than what your sales will reflect. And so you'll have a buildup. Your inventory increases, and that's consuming cash. And receivables must be going down, I guess. So likely, we can tell a lot from this, what's being projected here, because it's saying that you're going to consume cash from inventory, but free up cash from receivables. And so that would pretty much suggest that maybe your sales aren't as good as you thought they would be, or aren't as good as they were in the past. At this point, there's no projected plant improvements. If there were, that's something you would decide you would put in there. There's no financing activities. Again, that's something that you would decide that you would put in there. And therefore, the net change you're basically you're going to improve your cash position by $4.8 million, and that really comes from the depreciation, offsetting your loss. So exactly how we looked at before, in terms of reading this cash flow summary. Just need to again be sure that you understand that this is a pro forma. Companies again do this. They maybe don't do it for a whole year. Sometimes they'll do cash budgets that'll go out several months. They might go out to a year or two, but they do this all the time because they are trying to plan for cash needs far enough in advance so that they know how to meet those. So let's talk about real quickly 3 scenarios that relate to the cash flow perspective for capital adequacy, and then we'll wrap this up. The first one of those, again, we kind of talked about that. Imagine an overinvestment. So the firm has $5 million in cash on hand. They expect to earn another $5 million from operations, and that's after the depreciation adjustment and all that. They sign an agreement to spend $100 million on new product this year. So with whoever it is that's helping them with that, they've now signed a contract. They have to spend the $100 million this year. They're planning on having $100 million over here. They're going to raise $90 million through debt and equity, and use the $10 million to pay off the rest of it. So they're feeling pretty good about that. They go out to raise their equity, and they are able to raise $20 million there. They're only able to raise $50 million in debt, so $70 million total. They needed $90 million, so they start out with $5 million. Source of cash, they get $5 million from operations, $20 million from equity, $50 million from debt, so that's $75 more. Uses, they have to spend the $100 million because they're contractually obligated. Ending cash, they're $20 million short. Now, understand, this isn't just a change at this point because we have the starting balance and the ending balance, all right? They actually are $20 million short on cash. So they are insolvent. They are unable to meet their obligations. Somewhere along the way, whether it was with this $100 million or with something else, they had to choose to not pay somebody. Second scenario, we've talked about a little bit, working capital change. I want to give you real kind of numeric examples of that. Assume, again, the firm has $5 million in cash on hand. They expect to earn another $5 million from operations. Their policy is that they extend 3 months of accounts receivable terms to a customer, and that typically 50% of their customers make use of these terms. They have typical sales of $200 million. So you could calculate out that basically their sort of typical accounts receivable is that half of the people will take advantage of that. And so about $100 million of their sales will be on receivables. And that $100 million, they're only holding for 90 days, so 3/12 of a year. And so, in fact, in their accounts receivable at any one point in time, they would expect to have a balance of about $25 million. Fortunately, their sales jump up greatly to $300 million a year. Okay, and so that's good news. For whatever reason, they don't see any increase in their cash from operations from that. But 100% of their customers now start making use of their accounts receivable terms, right? So they're selling more, and more of their customers are using that. And so their accounts receivable jumps from $25 million to $75 million. So they're consuming an extra $50 million in cash. They only have $10 million, so they can't fund that. So again, they start out with $5 million. Source, they get another $5 million from their operations. They use $50 million more in accounts receivable. They're $40 million short. So that is actually something that can happen to a company, is that they can find themselves very, very short on that. Ideally, a company would respond to that by saying, look, I've got all these great sales. Let me go out and borrow some money or do something, right? Maybe some short-term borrowing to cover that. But if they don't, if all they do is just sort of sit back and let it happen to them, they wind up $40 million short, and then they're in a real bind. Scenario 3, operating loss plus a current debt payment that comes due. So again, let's just assume that They have $5 million cash on hands. They expect to earn $5 million from operations, and they have an $8 million debt payment that's maturing at the end of the year. So they have to make that. That's a non-discretionary payment. Instead of running a $5 million profit, they actually run a loss for the year, generates cash losses of $6 million. So now the operations, if you look at it, they have a starting balance of $5 million. They have no source of cash because the operating loss now becomes a use of cash, $6 million, plus the $8 million on debt. So they had $5 million. Here's $14 million that they need to use. So they are $9 million short. All right. So again, those are the kinds of things that can happen that basically would put you short on cash. And if you are not aware of that and planning ahead and maybe taking actions to raise funds in some other way, then you find yourself insolvent. More importantly, in the cash flow perspective, you find yourself in default. That $9 million isn't just a negative number on an accounting statement. It would be like saying that you are overdrawn at the bank by $9 million. Well, the reality is the bank's never going to let you be overdrawn by $9 million. They will simply stop processing the checks. And so whoever it is that you owed that $9 million to, the check you gave them is going to bounce. And now they're going to see you in court and potentially shut down the company. So again, the whole point of all of this is to give you the very high level perspective on the importance of managing capital adequacy and the fact that it's both a short-term issue, I got to make sure that I have cash, so a tactical issue, and a long-term issue, a strategic issue, in the sense that I need to run my company in a way so that my assets exceed my liabilities. And the more they exceed the liabilities, the better from a capital adequacy standpoint. Anyway, hope that's useful.